Hello again, Robert Schein, Managing Director and Partner with Blanke Schein Wealth Management. Well, today is Monday, May 4th, 2020. There are several topics, headlines, and market observations that we're going to go through in today's daily video episode for you. But to all our clients, friends, and family, again, thank you for your continued support and thank you for sharing. So let's get right to it. So Warren Buffett this weekend held his annual shareholder meeting in a non-traditional style. If you recall, and you're a fan of Warren Buffett, like we are at Blanke Schein Wealth Management, you notice that this weekend's shareholder meeting was sort of a virtual town hall. Warren's up there answering questions in a Q&A fashion, very different than years past, where he would have sort of a convention and a product fair type atmosphere where he would showcase all of the different businesses that he's invested in, and he's always been very proud of that. Everything from chewing gum to ice cream to soda pop, everything in between. He's always been showcasing sort of his investment in America, and it served him quite well through many decades. He's been very successful as a result of that. His one take-home point was never bet against America, and I truly believe that, because he's even pointed out that we've been through world wars, we've been through Great Depression, we've been through great recessions, 9/11. So don't ever bet against America, because America will come back, and it always will bounce back stronger. And he's benefited from that, from investing alongside, betting on America and betting on Americans to do that. And I think those that have been invested in the capital markets have seen that success as well. But he also has a great, point that I want to bring up, which was, he's human, right? He made a bet in the airline sector that he had to sell because he doesn't believe going forward it's the place to be. So he also admits that when he was wrong, and he quite frankly said, yes, I was wrong, I got it wrong. And so, again, he's one of the greatest investors of all time. He's done that, made investments in capitals, contributions to great companies in America, but he also has the fortitude and sort of the strength to know, hey, you know what? I made a mistake, and that's okay. So Warren Buffett is human. We learned that this last weekend. He admitted that, but he said the most important thing is never bet against America, and I think he's 100% right. So our next topic, we're going to look at what the bears are looking at. Markets are made of bulls and bears. Those are betting for the market to go up, and those are betting against the market so it goes down, if you will. And as we just discussed with Warren Buffett, he's a perennial bull. He always believes in the market over time. If you invest with great companies, great management teams, with a product or service that can't be replicated or duplicated for the most part, over time, that will go up in value, and he's proven that to be the case. So he's a true bull as it relates to investing. The other side of that is when you get to periods of volatility, and you get into a bear market where the market drops by 20% or more. That by definition, it's a bear market. You have bears out there that are seeking within the volatility. They're looking for the market to continue to fall. You'll see sort of headlines out there, and in fact, you'll see private equity firms that are betting against the market. They'll put out headlines, and they'll get on the news from CNBC to all of these other business shows, and they'll literally talk about the worst case scenario. But what we don't know is where their bet is, and oftentimes come to find out they're bet against, they're a bear, or they're betting against the market itself, and they actually had a headline or a piece of paper or white paper or research out there that actually proves their theory. So it's a fear-driven case. But the bears actually have to look at some things, just like the bulls have to look at the market itself. And oftentimes when there's unknowns out there and all these headlines, we have to go to the fundamentals. So when there's all these headlines out there and you can't make heads or tails, and there's bulls and bears and they're all betting against each other, what do we need to do in the investing world? Well, the number one thing is you always go to the fundamentals, and the fundamentals will actually help you make sense of the direction of the market, both short and long term. So fundamentally speaking, we look at credit spreads, and credit spreads as it relates to investment grade corporate right here I have standard S&P 500 credit agency. So we want to look at triple B minus versus double B plus. So essentially what I've drawn the line is And what the markets are looking at is investment grade versus non-investment investment grade paper, and all the spectrums sort of that are bouncing up on both sides of that. Why that's important, what that actually means is, well, think of it this way from a consumer standpoint. 800, around an 800 credit score, that's, A paper, triple A paper. Very few corporations in the United States and S&P 500 have triple A credit rating. Much like, if a consumer has, below 700, even 600s or 400s, 500s, that's sort of, you're getting to the lower end of the spectrum of your credit worthiness. So, in times like these where we have volatile markets, you want to look at and keep an eye on the non-investment grade or lower credit quality out there status, because that indicates, if the junk marketplace is having continued trouble, that means that there's more trouble out there in the economy. And it's also the same thing for the consumer. So the 400, 500 credit scores out there, are having tougher time. And if you translate that even into a business, these are rated agencies, those are public companies. What about those small businesses right now that are trying to access the small business, loans that are out there? So, this story isn't over by any stretch of the imagination. The markets are watching this. We're watching this extremely closely at Blanke Schein Wealth Management, because this is going to be a continuing issue as we get through this economic downturn. So with all those unknowns, it's not uncommon that we see the S&P 500 trade in a range like we discussed. And there's going to be, market's going to be grinding its way higher, but it's also going to come down and draw down from time to time. We don't believe testing the lows, as I said before, is going to happen. But we also do see a drawdown, and the drawdown effect has happened 9 times over the sample set that I've looked at from 1957 to March of 2009. And the average from the drawdown, if you will, from the initial drawdown is about 27 days, and essentially that means that within the first 30 days of the initial low in the market that was set, in this case the S&P 500, it's not uncommon to have another drawdown within the first 30 trading days, if you will. 27 is the average. So some of them are longer, some of them are shorter of when we had that drawdown. The average size of the drawdown is about a 10.3% over those 9 periods of time. So some of them are more in terms of how much they've gone down, and some of them are less in terms of how much the S&P 500 actually drew down. So you get an average of about 27 days, and you get an average of about 10%. So it would not be uncommon, while we're in this trading range, as we talked about before, that we see the markets bounce back and forth. Why? Is because we don't have clarity on forward earnings. So I just want to let you know that we're on top of this. In fact, in trading ranges that we see is when we have and find the most opportunities. And that's something that we look for and welcome at Blanke Schein Wealth Management on a go-forward basis. So I just want to let you know what the markets are seeing, what our observations are, and more importantly, stay healthy, stay safe, and thanks for your time today.